Welcome back to Investing Talk Podcast.
Today we're looking at Dragonfly Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. It's a bit of a mixed bag here, really reflects what's happening across the energy storage sector. With Dragonfly Energy, you sort of see the story of, well, short-term challenges needed for that long-term vision.
Right. Let's maybe start with the financials. The headline revenue for 2024 definitely showed some headwinds. It fell to $50.65 million. That's a pretty steep drop, over 21% year over year.
Yeah, it is. A tough number. Probably reflects, supply chain stuff, maybe the RV market cooling off a bit.
But that 2024 figure, that's looking backwards now, isn't it?
Exactly. And what's interesting, or maybe encouraging for investors, is the TTM number, the trailing 12 months revenue. That's actually higher, sitting at $54.54 million.
Okay, so that suggests maybe the more recent quarters have picked up some steam, recovering from that dip.
It points that way, yeah.
Yeah.
Shows some recent momentum.
But here's something I find really interesting. If things were tough, how are they keeping their pricing power? The gross margin is still, well, pretty healthy at 25.56%.
That's a great point. For a hardware company, especially in batteries, that's quite strong.
Does it suggest they're just really efficient? Or that people really value their specific product?
Probably a bit of both, but I lean towards the product quality argument. It suggests customers are willing to pay a premium for what Dragonfly offers.
Okay, but that strong gross margin, it doesn't mean they're making money overall, right?
No, definitely not yet. That's the immediate hurdle. They're currently unprofitable, showing a TTM net loss of around $30.45 million. Quite a bit of red ink.
Right. So wait a second. How do you have a 25% gross margin but still lose over $30 million?
Yeah.
Where's that cash going? Is it just huge operational costs or?
It seems to be overwhelmingly investment in the future. R&D, expansion plans. It's less about, say, inefficiency making the current batteries and more about funding the next thing. Developing new tech, building out infrastructure.
Oh, like the solid-state battery stuff we'll probably get into.
Exactly. They're burning cash now to try and capture more market share later and push that technology forward.
Got it. And that kind of aggressive spending needs fuel, needs capital. Which brings us to the recent equity offering.
Yep. They did a public offering, raised somewhere between $25 and $55 million, plugged the immediate liquidity gap.
But that came at a cost, didn't it? Dilution.
A significant cost. Shares outstanding jumped 26.04% compared to last year.
Ouch. So for you, the listener holding shares, that means the company's earnings per share, if they eventually get profitable, now needs to grow by an extra 26% just for your slice of the pie to stay the same size. That's a big hurdle.
It absolutely is. Yet, look at the analysts. They seem optimistic they can clear it. They've actually upgraded the consensus EPS estimates for 2025. They're forecasting a loss still, but a narrowing one, around $2.54 per share.
So the thinking is, the money they raised, even with the dilution, will fuel enough growth or cost savings to improve the bottom line.
That seems to be the bet. They expect better cost management, better operational leverage down the road. They're betting on the company's underlying strengths.
Okay, let's talk about those strengths, the moat. What makes Dragonfly defensible?
Well, it's really their focus. They didn't try to boil the ocean and go straight for passenger EVs like everyone else. They carved out a niche in deep cycle lithium-ion batteries. Think RVs, boats, solar storage, off-grid power systems. They really dominate that specific space.
And it's not just the battery cell itself, right? It's the whole system.
Precisely. It's the intelligence, their proprietary battery management systems, the BMS, and how they integrate everything. The battery, the inverter, the charging tech, it makes it simpler for manufacturers putting them in RVs and for the end user. That creates stickiness.
And they just got a new patent, too, for wake speed.
Yeah, the wake speed charge control technology. That's important because it helps optimize charging from different sources. Solar, the engine's alternator, shore power means the battery lasts longer, performs better. That level of smart integration is hard for competitors to just copy.
Okay, that's a tangible advantage.
Yeah.
Now, they want to take that niche expertise and go bigger.
Much bigger. Management's talking heavy-duty trucking, industrial power applications. That's a huge jump. We're talking moving from their specialized area into a potential market size of, what, $56.8 billion? Massive difference.
That's hugely ambitious. Are we seeing any signs it's actually happening, or is it just talk for now?
We're seeing some early signs. They landed a distribution deal with Hybrid Power Solutions, specifically aimed at getting into that industrial market. Plus, their existing relationships with RV guys like Ember RVs and Awaken RV seem solid, keeps the core business humming.
And then there's that award, Battery Technology Company of the Year for 2025.
Yeah.
How much stock should we put in that? Is it just PR fluff given the losses?
You know, in this tech-heavy sector, I think it carries some weight, especially when you link it to their solid-state battery work. It reinforces that idea of a technology edge. It adds credibility.
So the solid-state progress is sort of the speculative wild card here.
Absolutely. That's the potential game changer long-term. Solid-state promises more energy, faster charging, better safety. If Dragonfly commercializes that effectively, the whole valuation story changes.
And that potential, that uncertainty, is probably driving the crazy stock volatility we've seen.
Oh, completely. Look at the 52-week range, 0.15 cents up to nearly $5. Just bonkers.
Where is it now? Around 88 cents?
Yeah, currently trading near zero as at 88 cents. So near the low end of that huge range, but there has been a little shift lately.
What kind of shift?
Well, technically the trend seems to have shifted towards neutral, maybe slightly bullish. You're seeing some higher lows forming on the price chart. From a technical perspective, the big level everyone's watching is resistance near $1. Breaking that would be significant.
A psychological level, too.
Definitely. If they can hold support around the Doro 80 cents mark, some analysts see a potential trading range, maybe bullishly, up towards $1.50 over the next few months.
So significant upside but the market wants more than just revenue growth now, doesn't it? Especially with that cash burn.
Exactly. They need to see a clear path towards profitability. The preliminary results still showed negative adjusted EBITDA. So the question is, when does that turn positive?
Yet despite that, the analyst consensus is still really positive.
Wildly positive, actually. Consensus is a strong buy with the 12-month price target averaging $1.50. That's, what, over 70% upside from where it is now?
Okay, hold on. Given the dilution we talked about and the fact they have negative equity,
Yeah.
how do analysts get to $1.50? That feels like pricing in perfection.
It definitely prices in strong execution, no doubt. But it also likely factors in the speculative buzz around the company right now.
What kind of buzz?
Well, the main rumor is potential M&A activity. Speculation that a larger player might want to acquire them specifically for that solid-state battery technology. That R&D has inherent value.
The tech buyout angle. Makes sense. Any operational rumors floating around?
Yeah, whispers about maybe landing a major new OEM supply contract. Could be in that heavy-duty trucking space they're targeting, or maybe another big RV name.
That would definitely validate the expansion story.
For sure. And then there's always hope for, new government funding or maybe pilot programs for the solid-state tech getting deployed. Adds credibility and potentially non-dilutive cash.
Right. And beyond the company-specific stuff, there are market events, too, like index changes.
Yeah, keep an eye on the December ETF and index rebalancing and then the 13F filings in January. Those show you what the big institutional funds are doing, buying, selling, holding. Gives you a sense of the smart money flow.
Okay, we've covered the potential upside. Let's be diligent about the risks, because there are definitely some big ones.
Absolutely. The financial structure is probably top of the list. We mentioned the dilution risk already. But also, the company is operating with a negative equity position.
Can you explain that for the listener? What does negative equity practically mean?
Sure. It basically means their total liabilities, what they owe, are currently greater than their total assets, what they own. Now, you do see this sometimes with high-growth companies that are investing heavily and haven't reached profitability yet. It's common in venture-backed type scenarios.
But it's still a risk flag.
It's a major structural instability flag, yes. It means their financial foundation is shaky right now, even if it's potentially temporary while they scale up. Needs careful watching.
And that dilution risk isn't gone either, right? If they burn through cash faster than planned.
Exactly. They might need to raise more capital, which could mean issuing more shares, putting more downward pressure on the price for existing holders.
But maybe the biggest risk, the one everything hinges on near term, is just execution.
I think so. Management has put a stake in the ground. They've publicly targeted reaching EBITDA break-even by Q4 2025. Pretty much the entire bullish case, that analyst confidence, that $1.50 target, it all assumes they hit that guidance, if they miss.
If they miss, the story falls apart, at least temporarily.
Yeah, the stock could face serious pressure no matter how good the tech might be conceptually. Performance has to follow the promise.
And we shouldn't ignore the general market risks either, right? Energy storage is still volatile.
Definitely. Their niche focus helps buffer them a bit, but they're still subject to things like changing regulations, shifts in commodity prices for lithium and other materials, and just intense global competition.
Okay, so let's try and wrap this up. How do we synthesize all this?
Well, Dragonfly Energy really feels like the textbook definition of a high-risk, high-reward play. On one hand, you've got clear strengths, strong products, a dominant position in their core market, real technological innovation, especially with solid-state potential, clear tailwinds.
And on the other hand,
On the other hand, you have significant, undeniable short-term financial instability, negative equity, ongoing losses, the dilution factor. It's a heavy counterweight.
so success really boils down to execution in the coming quarters, proving they can turn the tech into profit.
Precisely. It hinges entirely on management demonstrating, starting with this next earnings report, a credible, visible path to profitability. They need to show they can translate that technical advantage into actual financial results.
The core question you must ask yourself is this: can the undeniable technological moat they've established and the future value of that solid-state innovation successfully overwhelm the very real, immediate financial headwinds that are currently weighing down the stock price?